Whether you've just started investing or if you've been investing for a while, investing with small amounts of money can seem, well, pointless. Even if you manage to earn 20% returns in a year, it can feel like you barely made any progress, especially when you're comparing yourself to other people with their 5, 6 or 7-figure portfolios. But the thing is, choosing how to invest your first £100 or £1,000 is just as important as choosing how you would invest £1 million. So with that in mind, we're going to take a look at how we should approach investing with little money, so that we can maximise the early stages of our investing journeys. Because of course, we all have to start somewhere, and unless if you suddenly come into a load of cash, we're going to have to start investing with what seems like little money. But this can seem like a waste of time at the beginning. Let's say that you invest £500 in your first year, and you earn a healthy 20% returns on that. You'd only profit £100. And yeah, £100 profit is awesome, but it's not really life-changing, and we're certainly going to have to earn a lot more than that if we're going to want to reach our financial goals. So this often drives investors down the route of maximising returns. If 10 or 20% returns aren't going to be enough in a certain year, how can we try to boost those returns even further? This is where stock picking or active management comes into the scene. If the market in general is not going to provide the returns that we want, is it possible for us to pick the best stocks to get the best returns? Or maybe we can try to invest in active funds, where the top fund managers from all around the world assemble a team of professionals to build a portfolio in an attempt to beat the market. Surely this has to work. Some active managers dedicate their lives in order to try and beat the market, and the combined experience of the people in their team is older than Jesus. Let's see how they do. This graph from Vanguard shows the percentage of active funds that underperformed their benchmark over 15 years, from 2004 to 2019, across a range of asset classes. The blue bars represent the data that only includes funds that survived, and in all but one example, more than 50% of the funds underperformed the benchmark. But this doesn't tell the whole story, as many active funds actually fail completely, and they either merge into different funds or liquidate. The grey bars include the survivors and the dead funds. Across every asset class, a minimum of around 80% of funds underperformed the benchmark, with some examples nearing 100%. These red numbers along the bottom showed how the median surviving fund returns compared to the benchmark. Again, all but one of the funds have negative values. So if you do choose to go down the active management route, there is a very large chance that you're going to pick a fund that actually ends up performing worse than the market that you're actually trying to beat. But what if the teams of professionals with years of experience between them are actually just doing a terrible job? What's to say we can't beat the market? Picking stocks must be easy. Surely we can avoid the big bad companies that tarnish the returns of the entire markets. This is an abstract from a paper in which all stock transactions on the Colombian Stock Exchange were analysed from 2006 to 2016. The key findings were that investors trailed the markets by around 4%, but this underperformance was probably even more pronounced when transaction costs were considered. Now I could reel off paper after paper that shows that trying to beat the market is pointless. We should not try and chase market beating returns. It is not a quick and easy solution to getting rich. So let's reconsider things a little and turn our attention to one of the greats, to try and figure out their secrets to attaining infinite wealth. But before we dive into that, I just want to quickly mention that around 65% of you lot watching aren't actually subscribed to the channel. So I tell you what, the next time an ad pops up onto this video, just pop out of the window for a second, go down and hit subscribe for new passive based investing content every single week. And I tell you what, smash the like button whilst you're down there too. Perfect timing. Warren Buffett, the self-made investing phenomenon who reportedly has a net worth of over $100 billion. Now yes, this seems a bit counterintuitive to what I was saying before, as Warren Buffett is considered one of the greatest active managers of all time. Since 1965, he has reportedly delivered an annual rate of return of around 20% to his shareholders. But I think people are missing the point. His success is not down to what stocks he picked or when he picked them. I think it's much more than that. Let me show you what I mean. This graph here shows the net worth of Warren Buffett over the years, starting with $5,000 when he was 14, all the way up to $58.5 billion when he was 83. If we focus on the beginning stages first, we can see that he too started investing with relatively small amounts of money. I mean, $5,000 by age 14 isn't bad, but it's certainly not a massive amount of money. He just made it count. It took him 5 years to double that money, meaning that he had a net worth of $10,000 at 19. After working hard and saving a lot, he managed to accelerate that growth, racking up an impressive $1 million by the age of 30. But again, when you look at the scale of the graph, this was absolutely nothing in the grand scheme of things. It wasn't until his 50s where you start to see some exponential growth in his net worth. So what changed? What did he suddenly crack in his 50s that he wasn't doing before? Well, the truth is that he changed nothing. He still invested in the same way that he did before. All he did was stick with a process and kept saving and investing as much money as possible. The key is that he has been in the game for so long. Warren Buffett is now 91 years old, meaning that he's been investing for over 75 years. We shouldn't waste our time chasing after the best possible returns. Instead, we should focus on trying to invest every single month and staying invested for as long as possible. This is true regardless of what investing strategy you choose to go with. Now, I can't advise you on exactly how you should invest your money because I'm not a financial advisor, but I can remind you of the data that we just went through before. Chasing after market beating returns for active management or trying to beat the market by picking stocks does not have a good track record. So if you can't beat the market, why not be the market? You can do this by investing in a globally diversified portfolio, which has two key features. Firstly, it is globally diversified. By investing in thousands of stocks from all around the world, you're going to replicate the global markets. The more stocks you have, the more you become the markets. By making your investment portfolios mimic the global markets, you're going to be beating 90% of active managers out there, and you'll also beat a bunch of stock pickers too. Many investing platforms actually offer globally diversified portfolios in the form of a single fund, which also means that you're going to have a much easier time compared to stock pickers, who are going to be battling the market every single day. The second feature, which is massively important, is the low cost side of things. The lower your costs, the closer your returns will be to the markets. This idea is explained well through this graph that we showed recently in a Vanguard paper. The bell curve on the right shows the variety of returns of the market, whilst the bell curve on the left is real investor returns. For us to get as close to the curve on the right as possible, our costs need to be as low as possible. In the same paper, Vanguard discussed the importance of saving money and saving as much as possible over the years. The results are shown here, with the red line showing the highest saving rate of 10%, compared to 5% and 0% in the other two colours. The more money you save, the more likely you are to earn exponential returns. So when we start investing with small amounts of money, we need to stop worrying about exactly how we should invest that money. Instead, we should focus on how we can keep on investing that small amount of money every single month. And then, each month after that, try and save more and keep on investing more. This is the same lesson that we can learn from our mate Buffett. Whether you're investing £100 or £1 million, it should be treated in the same way. What's actually more important to focus on is having a plan. If you're investing small amounts of money, then it's very likely that you're at the beginning of your investing journey. Setting financial goals, getting in control of your personal finances, and consistently investing are all good habits that are going to set you on the right path. The key is for us to think about how we can keep on investing small amounts of money until it becomes a larger amount in the future. Compound interest is going to be doing all of the hard work for us, in the same way that it did all of the hard work for Warren Buffett. It took Warren 52 years of investing to reach $17 billion. He then more than doubled that amount over the next 6 years. To break down his success, I modelled his investing journey using a compound interest calculator. Starting with $5,000, earning 20% per year, and investing over 69 years, it turns out you need to deposit around $1,000 a month on average to reach his $57 billion total by age 83. To show that this isn't all about the returns, we can lower this to a much more modest 7%. Which is similar to the global markets, and the value is still over $20 million. Now, of course, the two final amounts are largely different, but it is still enough to prove that long-term investing is the key driver behind Warren Buffett's success. Buffett was the one in a billion who managed to pull off active management to such a high class. But as low-cost passive investors, we too can get massive returns. So to make sure that you're getting the most out of your first £100 or £1,000, you first need to make sure that you've got a plan in place. Pick a portfolio or an investment strategy that is proven to work. The more that you believe in your portfolio, the better, because the more likely you are to stick with it and the more returns you're going to get from that portfolio. Then start investing. If you have a simple strategy, then this should not be a complex process. Just make sure that you keep on investing as frequently as possible. Spend time actually working on improving your savings, either through increasing your income or decreasing your outgoings. And finally, the most important step is to stay consistent for as long as possible. The more money that you can get into the markets for as long as possible, the better. It may seem a bit pointless at first when you're only earning small profits each year, but over time, those profits are going to become massive returns. After years of dedication, you're going to start to see your portfolio grow more and more, until the numbers start getting real serious. Just remember to stay focused on your own investing journey rather than the investing journey of those people around you. Whilst it can be useful to check up on others and to see how they're doing, don't let it distract you, and certainly don't let it make you feel like you're doing a poor job. There is always going to be an investor out there with a bigger portfolio, or somebody who's earning more returns than you. But forget about it. Block out the noise, stick with a plan, and keep investing. Besides, the fact that you're investing in the first place puts you ahead of most people in the UK. Finally, remember that time is our ally. The last few years of our investing lives are going to be the most fruitful. You have to remember that. But to make sure that we're reaping the benefits of a well-funded portfolio when we're older, we first need to put the right building blocks in place today. Because the truth is, with a long-term investing mindset, we're all investing small amounts of money. It may seem insignificant now, but in the future, it can lead to massive wealth. Hopefully, you found this video useful. Now, if you want to see how I invest my money on InvestEngine, and if you want to get involved in a portfolio challenge where you can win 30 quid, then watch this video here. In the meantime, thanks for watching everybody, and I'll see you in the next one.